Hello everyone and welcome to Atomic ACCA's pre-mock exam solving series, and in this video we are going to look at section B of financial reporting March 2025 exam. So section B would be considering 3 case studies, each case study having 5 questions, each question worth 2 marks. So that's like 10 marks, 10 marks, 10 marks, altogether 30 marks once again. So let's begin. So we'll have a rough understanding about what is the case study, then we'll start reading the requirements. Therma Energy Company operates in the energy and environment solution sector. Currently, the company is constructing large power plant for its customers. These contracts are long-term in nature and take many years to complete. Therma Energy has 3 contracts in progress at 31st December X4. Okay, so that's the year ending. All began in the current year. Okay, so no stories before this. The company uses the input method to account for profits on its power plant project for all contract. Input method means based on the cost generally. So contract 1, 2, 3, we have the total contract price, which is the total revenue. Contract cost to date, so that is cost incurred. Cost to complete, that is like the estimated cost to finish this. The amount billed and received to date. So that is about what progress billing and all those things are. Okay, so that is over. Now let's start reading the requirements. How should the contract asset or liability be recorded in the statement of financial position of Therma Energy Company for contract 1? Okay, this is contract 1. In accordance with IFRS 15. So they want to see how the contract asset or liability is to be recorded. So how to get the contract asset or liability? What are the two things we compare? We see what is the revenue to be recognized based on the SOPL, and we see what is the progress billing. We compare that and see whether we have a contract asset or liability. So for contract 1, we can see that first let's get the progress percentage. That is the step number 1. Total cost to date is 8,000. Cost to complete is 2000. That means total cost is 10,000. So cost incurred so far divided by total cost of 10,000. So 8,000 by 10,000, it's very straightforward. That will be 80% completion. Now, if total revenue is 12.5 million, that is 12,500, then 12,500 multiplied by 0.8, 80% completion is equal to 10,000 revenue. Now, 10,000 revenue is there what I am eligible or what I have the right to get. But what did I bill my customer? 11,000. So I was supposed to get only 10,000, or I am eligible to get only 10,000, but I billed my customer 11,000. So there's extra 1,000 that I am still pending to be eligible to get. So that 1,000 is called as contract liability. So $1,000 contract liability will be our answer over here. Next one. What amount of revenue should be recognized in SOPL with regards to contract 2 in accordance with IFRS 15? Now, 9,000 plus 9,000 is 18,000 and the contract price is 15,000. So it's a loss making contract. But nonetheless, whatever it is, we have to see the progress percentage and just multiply it with the revenue, because question is not asking not profit or loss, but they're asking only about revenue. Now, total cost is 9,000 plus 9,000, that's 18,000. Cost incurred is 9,000. So 9,000 by 18,000 means 50% is complete. Now, total revenue for contract was 15,000. 15,000 multiplied by 50% will be 7,500. So since 3 zeros are here already, we don't have to write full 7.5 million. We have to write only 7,500. So that was also quite straightforward. Let's go to next one. In relation to contract 3, what amount should appear in SOFP for Therma Energy at 31st December X4 as per IFRS 15 and IAS 37 provision contingent asset liability? Okay, what do they want? Contract asset provision, contract liability provision, contract asset provision, contract asset provision. Okay, let's see. Step number 1, we need to find out what is the progress percentage completion. 6,000, 6,000, that means 12,000 is the total cost. 6,000 is cost incurred. That means 50% is complete. So that is over. Second thing, I need to see, considering they have mentioned here provision and all, probably this is a loss making contract. So the total cost is 12,000, but the total revenue is 11,500. That means we are on a 500 loss as of now. Now, when it is a loss making situation, we have things to be careful with. we'll just use the scratch pad to demonstrate. This is question number 18. So situation is like this: 50% completion is there. Total revenue is 11,500. Total cost is equal to 12,000, and that means there is a loss as of now is equal to minus 500. Now to record within SOPL, okay, SOPL extract, revenue will be equal to 11,500 multiplied by progress completion percentage. How much is that? Oops. 11,500 multiplied by 0.5 is equal to 5750. Okay. Next thing is cost incurred. Cost incurred is equal to, it's given over here, 6,000 is the cost incurred. So that's done. Now 5750 minus 6,000 will lead to only 250 loss. But when it's a loss making contract, there's a specific criteria, that is, you're not going to take the percentage of what is being completed, rather you have to take the whole loss and record it. So with that being said, if whole loss of minus 500 is recorded over here, 5750 minus 6,000 gives us only minus 250 loss. From minus 250, if I have to reach to minus 500, there needs to be an extra loss of 250. That extra loss of 250 will be part of the cost of sales. Cost incurred is also cost of sale. There will be one more element in this cost of sale, which is called as provision for loss. That is equal to how much? Minus 250. So, okay, where is that answer? Where did that go to? How much was here? 5750, I think. Yeah, 5750. 6,000 was minus. Okay, so let's just confirm this. 5750 minus 6,000 minus 250 equals to 5750 minus 6,000 minus 250. Then minus 250 and minus 250 is minus 500. Okay, so your answer is right. So provision for loss is minus 250. So we have provision of 500, so this is wrong. Then we have provision of 250 for all these three, so any could be an answer. Now I have to find out whether I have a contract asset or liability, because that is the other thing to find out. How to find out contract asset or liability? I'll calculate what revenue I can record, what did I bill my customer, and compare this. Now what revenue can I record? 5750. What did I bill my customer? Amount billed to customer for contract 3 is 5,500. So I was eligible to get 5750, but I billed my customer only 500, which means I'm eligible to get more 250,000. That is called as a contract asset. So contract asset of 250,000, provision of 250,000. This will be an answer. So that one is sorted. This is the same question. Hi. Identify whether each of the following statement is true or false as per IFRS 15 contract with customer. Therma Energy's accountant is unsure about how to account for sale and repurchase agreement. Okay. If the repurchase price is less than original selling price, entity must account for the repurchase contract as a financing arrangement. Financing arrangement means like a liability, which is wrong. Just demonstrating this. Repurchase price and original selling price. Let's say, for example, I sold something for $1,000 and I am telling them I will purchase it back for $1,500. That means repurchase price is greater than the original selling price. So it is more like when I sold it for $1,000, I got 1,000. Then let's say time period is 1 year. So over 1 year that interest is accumulating and I am paying back 1,500 over there. So it's like I got a loan of 1,000, I pay back with interest total 1,500. So when the repurchase price is greater than the original selling price, then the amount that I received is to be treated like a financing arrangement, like a loan. But if in case repurchase price is less than the original selling price, it's not a financing arrangement, it is to be treated like a lease arrangement. So this one is a false over here. Second one, If the customer is unlikely to exercise its right to obligating the company to repurchase the asset, customer is unlikely to exercise. That means I sold something and I am telling them, whenever you want it, you can tell, I will purchase it. So if you want, I will purchase it back. If you don't want, you don't have to sell it back to me. So it is up to them. The control is with them. Okay. So control is passed in this case. Sale is to be recorded as per IFRS 15. Now, the statement is telling customer is unlikely to exercise this power, which means they mostly are not going to sell it back to me. Very rare chances they will give it back to me. In this case, they are telling the entity accounts for the contract. Who is entity? Me. The seller is to account for this contract as a normal sale with a right of return. Just like how Amazon and all does. Let's say Amazon sells something to me. Now, when they sell something to me, I do have the power to sell it back. I mean, not sell it back, give it back to them if I don't like the product or something happens with them. Now, from their point of view, if they are very sure that, let's say they sold 100 goods to me, and they are thinking that, okay, maybe 98 goods will not come back, 2 goods maybe will come back, maybe will not come back. So based on their estimation, what is Amazon supposed to record? Revenue they will record for the amount they are sure that that will not come back, which is the 98 items. How about the remaining 2 items? They are going to record like a refund liability, or they are going to record it like a revenue with right to return. From my customer point of view, I have the right to return this product back to Amazon. Same point is over here. If in case customer is not likely to exercise that option of giving it back to Amazon, in that case, from Amazon's point of view, they can record a normal sale with a right to return. So that is true. Moving to final question from case study number 1. How will the change from input method to output method be accounted for in the financial statements? Okay, that is about progress completion. Therma Energy is contemplating to change the way they measure the progress towards the completion of contract. Company would like to adopt the output method based on the surveyor's report instead of the existing input method. Now, what options we have? Just change in accounting policy, change in accounting policy, estimate, estimate. Now, changing of a estimation, this completion percentage is always an estimate, be it on input method or output method. This is all estimates only. So first thing, it's clear, changing of input to output method is not an accounting policy change, it is an accounting estimate change, because you're estimating how much progress percentage is completed. So option 1 and 2 is out. Next thing, we have learned as per IAS 8, whenever an accounting estimate changes, you have to treat it prospectively. Future only you have to change. So it is a prospective application and not retrospective application. What does retrospective means? You have to change the past. Whatever you have recorded previously, you have to go change that. Now that is not to be done over here. You just have to see in the future years based on the progress completion changes, percentage change, whatever changes are coming up, just make that adjustments. So it is a change in accounting estimate with prospective application. With this, we are done with case study number 1. That's question number 16 to 20. Let's move to question number 2. Case study number 2. Following data relates to KRC company for years 20x3 and x4. Year end is 31st December. Okay. Contract 1. KRC started leasing new machinery on 1st Jan x3. So x3 31st December. Okay, that's like a normal calendar year. Okay, 1st Jan x3 they started leasing a new machinery. The lease period is 5 years and the rental is 500,000, is payable on 31st December every year. So this is an arrear lease. Useful life of the machine is estimated as 8 years and the present value of lease payment is 2050. Interest rate implicit is 7%. Present value of lease liability is given, lease rentals are given, estimated life 8 years is given, lease period is 5 years. Okay. So contract 1 is done. Contract 2. KRC acquired 25 tablets for use by its employees on 1st July x3. Now tablet is a minimal value asset. So we have to probably apply the IFRS 16 exemption rule. That is, you have to treat it like a normal rental expense. So they took it on 1st July x3. What is your year ending? 31st December x3 and x4. Okay. On initial payment of $3,000 followed by 6 monthly lease payments of $6,000 each, payable in arrear. So first you pay 3,000, use it for 6 months, pay 6,000, use it for 6 months, pay 6,000. So this is like a 1 year lease, and that too for 25 tablets. So we have to apply the normal rental expense arrangement over here. Next one, contract 3. KRC has been using a building for its administrative office. Its carrying amount on 31st December X3, that is first year ending, okay, was 2.2 million, that is carrying value. First Jan X4, that is the next day after that, first day of second year, it transferred the building to a finance company for a consideration of 2.5 million. So an asset that was having a 2.2 million carrying value, you sold it. Consideration means you're getting money for that, for 2.5 million. So you sold it at 300,000 profit, which equals to its fair value on that date. Okay. KRC immediately leased it back for the use of next 4 years. So this is like a sale and lease back arrangement. Estimated useful life of the building is 8 years. So the total life is 8 years. You're leasing it back for 4 years. Lease rentals agreed to be paid in arrears on 31st December is 500,000 each year. Interest rate implicit in the lease is 8%, and the present value of lease rental is 1656. Okay. Transfer satisfied with the condition for sale according to IFRS 15. So as part of sale and leaseback, we have three different types of accounting. The first one is over here, sale and leaseback for less than useful life, where sale is being met, which means that 5 entries will have to apply over here. So this is all that we have in the story. First one is a normal lease. Second one is a rental arrangement operating lease, the exception rule. Third one is a sale and leaseback, that 5 entry one. So let's start reading the questions one by one. Which of the following is deducted from the initial value of right of use asset according to IFRS 16? Amount of initially recognized lease liability, which is basically the present value of lease liability. That's what you start with. So that is something to be added. They're asking what is to be deducted. So option 1 is out. Incentives received by the lessee. Incentive means any kind of discounts that you're getting. Now when you get a discount, cost of the asset will go down. So option B could be an answer. Let's see the other ones. Any initial direct cost. When cost or payments are there, you are supposed to add it. So option C is out. Cost of removing or dismantling the underlying asset according to terms of contract. We know that decommissioning cost you have to take to the present value and add it to the cost of asset. So option D is out. With that being said, option B is the answer. Which of the following is not a condition to be satisfied for a contract to be lease according to IFRS 16? They're telling not a condition to be satisfied. So most of this will be a condition. Number 1, lessee should obtain substantially all economic benefits from the use of asset, which means they need to get the control over that. Correct. Asset must be identified. Yes, it should not be something random asset, or it should not be something that the lessor can easily replace it. Rather, it should be an identified asset. This is what I am giving to you. So second one is also correct. Lessee has the right to direct the use of the asset. Yes, they need to have the control over that. With elimination method, 1, 2, 3 is out, which means fourth one will be the answer. Contract must provide a right to buy the asset at fair value at the end of lease period. There is no mandatory condition that lessee should have the right to buy that asset. Maybe it could be there, may not be there, depending on the contract. So that's not mandatory for a lease to come into existence. So option D is the answer. For contract number 1, calculate the current lease liability to be recognized in SOFP at 31st December X4. When did they enter into lease? 1st Jan X3, 1st Jan X4, 31st December X4. This is like a 2 year time period, and this is an arrear lease. So we have to move from starting to next one to next one, and at the end of year 2 I have to see what is the current liability over there. So that's like a long calculation to do. Let's start. Useful life, they told 2050 is the initial liability, so we can take like this. Scratchpad will take for this. This is question number 20. Question number 23. Okay. So at T0, the liability is equal to 2050. Now on 2050, what will happen? Interest will climb on that, because this is an arrear calculation. So how much interest will climb? 7%. So into 1.07, 2050 into 1.07. So 1 year it will become 2193.5. And at that day, what will happen? you will minus out the lease rental. How much is the lease rental? 500,000. So 2193.5 minus 500. That is equal to 1693.5. This is the first year ending. Now I need to find out the current liability to be recognized in the SOFP at 31st December X4. So I have to jump one more year forward. So 1693.5, that is at T1 is equal to 1693.5 into 1.07. So I have to jump one more year. So 1693.5 into 1.07, that is equal to 1812.05, and on that day I will minus out the lease rental. So 1812.045 minus 500, that is equal to 1312.045. Now that is the figure at T1 ending. Now this 1312.045, I have to split it for current liability and non-current liability. Because this is an arrear lease, what I can do, I can find the next year closing balance and find what is the gap between this. So for T2 it will be equal to 1312.045 into 1.07. That I will increase it once again. So 1312.045 into 1312.045 into 1.07, that is 1403. Then minus out 500, I'll get 903.8815 equal to 903.8815. What was the answer over here? T1 ending was 1312.045. So if I find the gap between this, they want it rounded off to thousands, so I don't need all these decimals and all. I'm just going to find what is in between this. So that will be 1312.045 minus 903.8815. That will be equal to 1312. I'll just remove all the decimals. It will be 1312 minus 904 or 903, okay, somewhere around this. That will be equal to 408,000. Okay, if I just take the decimals correctly, let's see what will be the answer. 1312.045 minus 903.8815, 408.1635. So that will be, if I write 408,000, okay, so anyways 3 zeros are only over here. Okay, so that will be 408,000, not 409. Okay, it's 0.1, so it will be 0.03. So 408,000 will be the answer, and that is done. So we got what is the current liability answer. Next one. For contract number 2, calculate the amount to be debited to SOPL for year ended 31st December X3. So contract 2 is that operating lease. How much was the payment to make? $3,000 was initial, then 6,000, 6,000. So total rental to pay is 3,000 plus 6,000, 9,000, 9,000 plus 6,000, 15,000. Now you're taking it on 1st July X3. They want it on 31st December X3. So 15,000 if I pay it for, or if I split it for July, August, September, October, November, December. For 6 months it will be 15,000 multiplied by 6 by 12. So that's half of 15,000, which is 7,500. Correct only, right? 15,000 into 6 divided by 12. Yeah, okay. So 7,500. So that is done. For contract number 3, calculate the right to use asset and profit or loss to be recognized on 1st Jan X4. Okay, 1st Jan X4 means the date on which sale happened. So right to use for sale and leaseback, we have a working note. A small formula is there. Question number 25. So for right of use, the formula we have to apply is carrying value multiplied by present value divided by fair value. So If I do that calculation, how much was the carrying value? 2.2 million. 2.2 million multiplied by what is the present value? Present value is 1656. So 1656 divided by what is the fair value? 2.5 million, 2500. That is equal to 1457.28. So how are we supposed to write this? 1457. Okay, 1457. We'll just cross check this once again. Present value is 1656,000 divided by fair value is 2.5 million. It's equal to 0.6624. Okay, 0.6624 multiplied by carrying value is 2.2 million. So 3 more zeros. That's equal to 1457280. Now we can't write the 1457280 over here because they wanted rounded off to last 3 zeros. So correct only 280. We will round it off to 000. So that is done. Profit or loss has 3 steps to calculate. First, you have to get the total profit. Total profit is equal to 2.5 million minus 2.2 million. That's fair value minus carrying value. That's equal to 300k. Then I have to see what is the profit retained with me. How do I find that? Step number 1 multiplied by present value by fair value. What is step number 1? 300k. What is present value by fair value? That previous one we got. Present value was 1656 divided by 2.5 million. That's 0.6624. So 0.6624 multiplied by the step number 1 answer is 300,000. That's equal to 198.72. That's equal to 198.72. So if total profit is 300 and this much I retained, then profit sold or profit related to rights sold, that is equal to 300 minus 198.72. That's equal to 101.28, and zeros will follow that. But here profit or loss, 3 zeros are there at last, so I'm just having to write the main figure, that will be equal to 101. So let's just cross check quickly. Total profit is 300,000. 2.5 minus 2.2 million. Then 0.6624 into 300 is equal to 198.72, and the gap between this is 101.28. Okay, so that's the profit or loss to record. So that one is also done, and with that we are done with second case study for our section B. Let's move to final case study from section B. We have 5 more questions to do. Following information relates to questions 26 to 30. Fact company has identified a CGU which is comprised of the following assets on 1st July X3. So we have the carrying values here for machinery, other plant and equipment, land, technology. So all these 4 comes under non-current asset. Goodwill is 150, current assets 100, so total 1.8 million. Company has recently suffered a considerable decline in its revenue due to a new technology that has rendered facts existing technology completely obsolete. So company's technology became completely obsolete, so this goes down to zero recoverable amount, because we have to deal with specific assets impairment first. Next, considering the situation, an impairment review was undertaken on 1st October 20x3. So these are 1st July x3, 1st October 260x3, the impairment review was undertaken. So probably 30th June x4 will be the year end. So assuming like that. Recoverable value of the relevant CGU is estimated at 1.4 million. So carrying value is 1.8 million. 1.4 million is the the amount for recoverable amount. So total impairment will be 400,000. That is the gap between this. Now question number 1, which of the following assets require annual impairment review irrespective of whether there is an indication of impairment or not? Number 1, goodwill acquired in a business combination. So we know from the consolidation chapters that whenever a goodwill is acquired, it is supposed to be tested for an annual impairment review. Even IAS 36 says that. So option 1 is true. That means 1 and 3 could be the answer, 1 and 4 could be the answer, 1 and 2 could be the answer. Now, inventory does not have to be checked for annual impairment review. You have to see only if the value has gone down, if any market fluctuations, or if any discount is being provided. So 2 is wrong. That means 2 and 4 will not be the answer, 1 and 2 will not be the answer. So it's either 1 and 3 or 1 and 4. An intangible asset with an indefinite useful life, correct. With those with finite life, we have to do amortization over the life. When it's indefinite life, we have to check for annual impairment review. So 1 and 3 is our answer. So by default 4 will become wrong. Property, plant and equipment measured using revaluation model. It is only impaired if any indication is there. If not, you don't have to check for any impairment. So option 4 is not the answer. 1 and 3 will be your answer for this. Identify whether each of the following statements are true or false in accordance with IAS 36. Inventory should not be written down due to impairment as it is already carried at its recoverable value as per the rule. Yes, because as of IAS 2 we say that it is lower at cost or NRV. So whatever current assets you're seeing here at 100, it's already at the lower value. You cannot impair this any further below this. So this is true. Reversal of impairment loss should not take the value of an asset above its depreciated historical cost. Correct. Because once an asset goes down in value, let's say this is the normal level, and if normal depreciation happens, let's say carrying value is over here. So normal depreciation, it reaches over here. Now let's say if an asset got impaired downwards, so it is over here. If it is reversing, it should go maximum only up to this limit, where when normal depreciation happens, what would be the carrying value? That is the upper cap. The revaluation should not go beyond this limit above this amount, meaning on a normal depreciation, whatever is the carrying value, on reversal of impairment, it should not go beyond this. It will go only up to this limit. So that is what second point is saying. That is also correct. Calculate the carrying amount of machinery after CGU impairment loss is allocated and the asset values are written in accordance with IAS 36. So we need to find the recoverable amount of machinery. Okay, so let's just take what all numbers we have. Question number 28. Now first thing we told that 1.8 million carrying value, 1.4 million recoverable amount. So there's a total of 400,000 impairment over here, 400,000. Out of this technology, it was told that 150 it became completely obsolete. That means 150 impairment goes over there, 150. Now once all the specific assets are done, the next allotting should be based on goodwill amount. The goodwill is therefore 150. Now that also will completely remove, minus 150. So goodwill is also done. 400 minus 150, 150, 300. So there's a balance of 100. So 100 impairment is to be allocated. Now technology is over, goodwill is over. Current assets, we know that we don't have to impair it any further as mentioned in the previous question. So now we have only 3 more items remaining. What is the total carrying value of these 3 items? 700 plus 500, 1200, 1200 plus 200, 1400. Question is asking for carrying amount of machinery. So the impairment out of this 100 to be allocated for machinery will be equal to, machinery has 700 value divided by 1400 multiplied by 100. So that will be equal to 700 as a proportion of 1400 carrying value multiplied by 100. That is equal to 50 impairment. That means out of 100, if I, not this 100, out of 700, if I allocate 50 impairment for machinery, then what will be balance? 700 minus 50,000 is equal to 650,000. Let's cross check this quickly. 700, 900, 900 plus 500, 1400, 700 by 1400 is 50, 1500. Okay. So 650,000 is the total carrying value, basically the recoverable amount post impairment. Next thing, calculate the depreciation on the other plant and equipment. So this is other plant and equipment. They're asking you to calculate depreciation. Okay. with a carrying value of 464,000 for the year ended 30th June X4. This is 1st July X3, so 30th June X4. Given that the remaining useful life of the equipment is estimated as 4 years as on the date of impairment review. The impairment review is happening on 1st October 20X3. They are asking you to find what is the depreciation for this plant and equipment for 30th June X4. So that means 500 was the carrying amount on 1st July X3. Okay, this is like post impairment 464,000. All right. So 464,000 is on 1st October 20X3. From there onwards, we have October, November, December, Jan, Feb, March, April, May, June. So 9 months are there. So 464,000 divided by 4 years is the lifetime. Multiplied by, in this particular year, there will be 9 months of depreciation. So that will be 464,000 divided by 4 years multiplied by 9 divided by 12. That is equal to 87,000. Let's just confirm once again. 464,000 divided by 4 years is 116. 116 multiplied by 9 is 1044. 1044 divided by 12 is 87,000. Since 3 zeros are there already, I just have to write 87. Don't write the full 87,000. Don't write like this. Okay, that will be a wrong answer. So just write only 87 over there. So this question is also done. Next one. Which of the following is correct accounting treatment with regards to the plant owned by Fact Company in accordance with IAS 36 impairment of asset? Okay. Fact Company owned a specialist plant bought 3 years ago having an estimated useful life of 10 years. So that means 3 years ago, 10 years, now 7 years remaining. That has a carrying value of 1.05 million at 1st July X3. So 1st July X3 is year beginning. Cost was 1.5 million less accumulated depreciation of 450,000. Okay. So 1.5 million divided by 10 years means annual depreciation is 150,000. They told that it is bought 3 years ago. So 150 into 3 is 450,000 depreciation. So everything is going in line. Now we have a carrying value of 1.05 million. And it is depreciated using straight line method. Okay, understood. An impairment review was conducted at that date, that means 1st July, due to potential obsolescence of the plant, and recoverable value was determined as 975,000. So 1.05 million is the carrying value. New fair value is 975,000. So how much is the difference? 1.05. Really, just write 1050 minus 975,000. So 75,000 impairment happened. Okay. Then the impairment loss of that's already over here. Impairment loss of 75,000 was recognized on 1st July X3. All right. Subsequently, on 30th June X4, that is the year ending, situation improved, which means that the recoverable amount of the plant was revised to 1 million. So this is like an impairment reversal question. The plant revised to 1 million. Meanwhile, the accountant had processed an entry for the depreciation on 30th June X4 based on the carrying value post impairment. Okay. So we told earlier about the fact that when an asset is impaired and when it is reversed, it should be reversed only up to the maximum limit of what depreciation would have been there in a normal scenario. So in a normal scenario, if the depreciation kept on going, 3 years depreciation was done at 150, 150, 150, and you reached at the year beginning. So by the year end, you would have reached a normal value of carrying value should have been 1050 minus another 150,000. That means carrying value, we'll just write over here. Question number 30. So carrying value upper limit or like the max limit is 900 only. Only up to this limit it will go. Understood? So that is after 4 years of normal depreciation. Now what we have to see is the question options are reversal of impairment, post impair reversal, carrying amount and all. Post reversal, what should be the carrying amount? 900, because that is the max limit. You can go only up to this limit. So post reversal, here you can see 975 and 1 million. That means those both are not the options. Now we have to see how much reversal of the impairment loss is happening, how much gain should be recorded. For that, we have to see, it was said that at the beginning of the year impairment happened and it is 975,000. It is said that they had processed the entry for depreciation. So from the year beginning, now we have to pull it down by 1 year of depreciation. How much life was remaining at that date? 3 years were done, so 7 years is remaining. So with that being said, if 975,000 was the carrying value at the beginning of the year, divided by 7 years is spending, that means there is a depreciation of 139,000.28. This much amount of depreciation is there. So if I minus this out, how much is it? 139.28. 139.28. So if I minus this out from 975,000, so 975 minus 139.28, this will give me the value as 835,000. 835, or if you round it off, it will be 836,000. 836,000. From 836,000 carrying value, now I have to reverse it. But up to what limit? Only up to the limit of 900,000. So what would be the gap between this? 800 minus 800, sorry, 900 minus 836 would be equal to 64,000 reversal of impairment should happen. So you can see reversal of impairment loss $64,000. So that would be our answer over here. So if in case these two had to be an answer, it should be post reversal carrying amount 900,000, because that was the max limit. So this is the reason why we are choosing option B. And with that, we are done with question number 30, and that is the end to section B of this particular exam. Hope you have followed with all the techniques and tips whatever we have said so far, and you have been taking all the tips down on how we have been solving the section B questions. This exam has one more section to crack, that is the section C, which is the most predictable area. So see you soon in the next video.